This will be a brief lecture concerning the trade-weighted index. Now, we've talked about the real exchange rate, and we've talked about the nominal exchange rate, being the price of one currency in terms of another. And we talked about the real exchange rate being a better measure of our purchasing power in terms of another country, or relative to another country, I should say. But the trade-weighted index is even a more complex and a more astute measure of the exchange rate between us and our major trading partners. So what the trade-weighted index is a measure or a weighted average of the value of the Australian dollar, of the AUD, in terms of the currencies of our 20. So it is our 20. I'm going to put this in white. Of our 20 largest trading partners. And this is represented in index form. So it is in index form. Okay, so initially we're going to assume that the index started at 100. So the base year index was 1970, and the index points were 100 index points. Currently in Australia, as of October 2013, so as of October 2013, the trade-weighted index was around 71.8 points. And we can see that because Australia had a fixed exchange rate back in the 1970s, that was why the base year had such a high index point relative to this year, when it is now a floating or a market exchange rate. So why is the trade-weighted index important in measuring our purchasing power or our international competitiveness? Let's assume that the Chinese yuan, or the Chinese RMB, depreciates for whatever reason. Because we know that China is our largest trading partner, this would mean the trade-weighted index would actually appreciate because we can purchase more Chinese RMB. So the TWI would actually increase. So the current Australian dollar is worth more relative to our trading partners. So let's say something such as Thailand. So the Thailand baht depreciates by the same magnitude as the Chinese yuan, RMB. So the magnitude of the changes are actually equal. The trade-weighted index would therefore increase by a lesser amount because of this concept of weighting. So we know that the exchange rate relates back to the current and the capital and financial accounts, and it relates back to the exports that we can sell or the imports that we can buy. So because China is one of our largest trading partners, and even though Thailand is a very large trading partner, it is not a trading partner of the magnitude of China. A similar depreciation or appreciation of each relative currency would mean a relatively more different change to the trade-weighted index. So if China's RMB depreciates or appreciates, then the trade-weighted index would increase or decrease relatively, respectively speaking, by a greater amount than if the Thailand baht was to depreciate or appreciate by the same magnitude. And that's because it is weighted according to the relative importance of our trading partner. So weighted according to relative importance. And this is important to note because the weighting is very much reflecting or reflective of our export income and our income from imports, or how much we have to pay for our imports. Because say the Thailand baht were to depreciate, and assuming that we are including, say, our 100th largest trading partner, which obviously isn't included in the trade weight index, let's just assume that Thailand is the lowest weighted currency that we trade with. So it is the 20th weighted currency out of the 20 currencies included in the trade weight index. Obviously, because when this depreciates, we're not going to be trading with them as often and as frequently, or as the magnitude of our trades with China. When the Thailand baht depreciates, this means that the income of domestic exporters or the income of domestic importers would not be affected by the same magnitude as if the Chinese RMB were to depreciate, because of the such great magnitudes, large magnitudes of trade between us and them. And so we can see that because the trade weighted index is actually an index, this is used to compare changes in the currency's value. It's the actual value of the currency between years. So we can see that whilst the AUD appreciates in one year relative to yuan, but it also could have depreciated in the same year relative to the US dollar, we can use the trade weighted index to form a more overall or holistic judgment as to whether the AUD has actually appreciated or depreciated. So the trade weighted index helps us actually determine the currency's value in the international foreign exchange market from year to year. And it also helps us form a more whole perspective of the purchasing power we get for our currency. So it helps us finally realize the purchasing power of the currency, and more so than the nominal exchange rate. So that's the trade weighted index. It is a weighted average of the value of the Australian dollar in terms of the currencies of our 20 largest trading partners, and is expressed in index form. And the weights, I must stress, are weighted according to the relative importance and the relative magnitude of trade between Australia and the foreign country.